Crypto, self-managed super funds, and tax. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we welcome a very special guest to the program, Matt from Tax on Chain. With all the volatility this week in the markets and this time of year with tax and everyone thinking about that, we've certainly had a lot of questions around investing in crypto, tax implications, how to do it all in the self-managed super fund. So it's so good to have an expert here with us today in all those areas, and that's what you are. So welcome, Matt, and how are you going today?
Doing well, Chris. Thanks for having me. Yeah, definitely very volatile times. I would argue it's more interesting than it is scary. So yeah, we'll and I'm sure we'll talk more in detail about that soon. But yeah, good to be here.
It certainly has been interesting. I've had really it's been a great stress test, is how I've been referring to it, for people who are new to the space and going, well, you go through these big dips, you have lots of volatility in the market. You have to be prepared for that. And for them, it really put them under the pressure because they went, oh, it's pulled down. I go, well, hang on. We talked about this before it happened. Have to be ready. There's a lot for people to undertake and think about during these periods, isn't there?
Yeah, absolutely. And I think the biggest part is remembering why you got into the investment in the first place, or at the very least, just remembering that this is it's an emerging asset class, and that it is inherently going to be volatile. So I guess a lot of the people that do stay in this industry for a long time are the ones that do have that very high risk tolerance. Or at the very least, they've done their due diligence and they understand the asset class and the industry deeply. So I guess that, like any investment, really, as long as you have that deep knowledge of what you're investing in, and you've got that conviction, it is easy to stay in it and ride those roller coasters, even if it is. I mean, we saw markets like the Nikkei drop 12.5% in a market session. I mean, then
And
you
then bounce, an awfully large bounce following after that. Crazy.
almost a full recovery. It's incredible. But then, yeah, you also look at something like Ethereum. It dropped about 29% in a 24-hour period as well.
Mm.
And that's definitely nothing new to crypto as well. So yeah, it definitely takes a cast iron stomach to ride these kind of market movements. And it's just knowing that you either have the skills to be able to trade those effectively if you're a trader. Otherwise, if you've just got high conviction and you're happy to sit in an investment like that, it's got good fundamentals. As long as you can ride that out for a 2 to 5, sometimes even 10-year period, then yeah, things will work out. You just got to zoom out.
I've got lots of questions I want to pick your brain on today, but I think that's a really good segue into self-managed super funds when we talk about that longer time frame, because it's something we've had a lot of interest in here at Ainslie, where people come in and say, well, I want to take more control. I do want to invest in these assets that aren't readily available in other forms. So it seems from the article you put together that goes with this today, that you're talking about, really there's quite an increased rate of adoption that we've seen throughout this last financial year. Do you maybe want to step us through that a little bit, the self-managed super side?
Yeah, and like you said, there has been an incredible amount of adoption and an increased rate of adoption in self-managed super funds. Granted, not all of that's going to be going directly into crypto, but when you look at the numbers, you see that in the most recent quarters, we've had about 7,300 new registrations in the March 2024 quarter. And you go as far back as the start of the financial year for 24, there was 8,487 setups in the September 23 quarter. When you compare that to the previous financial year, though, September 2022 had 6,554. So that's a pretty decent uptick in adoption. So yeah, you see that kind of interest. Like you said, there's a lot of people that are interested in taking control of their value, their nest eggs. Some of that's going to go into physical assets like gold and silver bullion, which Ainslie offers those services for both buy, sell, and custody. A lot of people are now realizing that crypto is very much a digital extension of that. And again, I personally have had investments in gold and silver standard before, so I understand what's happening in the background there. And yeah, it is very much just that digitization of gold and silver. Then you kind of look to the digital native assets like Bitcoin, for example. And yeah, I think a lot of people are realizing, well, yeah, these are the kind of things that I can take full control over, and there's no way that the government is going to be able to take that unless they have my keys. And a lot of people will hear the saying, "Not your keys, not your crypto." So yeah, there is that inherent full control that is quite appealing to some investors.
And is that reflecting? I mean, you work for Tax on Chain. I mean, obviously, it's right there in your name that you are going to be appealing to people who are interested in this space, particularly the crypto aspect of that space. Is that what you're seeing flow through? Like you're seeing a number of these self-managed super funds being set up to invest in crypto?
Yeah, and like you said, we do see a larger representation of this. Just as you said, we're tax on chain. We do specialize in looking after the financial statements and tax returns and a bunch of compliance regulation requirements for people in general, but a lot of our specialty is in the cryptocurrency space. So yeah, I guess when people see our name, they reach out to us and want to get a bit more understanding of how they can take control of their superannuation, as an example, and invest it into crypto. Yeah, it is clear that a growing proportion of people in Australia are looking at ways to invest a portion. Some people, all of it, or some of them are going all in, but some people are also investing a small portion of it into crypto. I guess there's a number of reasons why you may want to do that. Like ourselves, some people are coming to us. They have very high conviction in this asset class. They see a bright future for it, and so they think, well, I want to be as invested in this as I possibly can. One way to do that is not just investing personally, but also investing a portion of your super into that. So that's one sort of bucket of people that approach us wanting to invest into crypto through their super. Some people are even just looking to achieve an added level of diversification. That's, I think, probably the larger representation of people that we do see. Yep. A lot of people are sort of realizing, well, you know what, I have a certain amount in stocks, bonds, gold, and other asset classes. It makes sense from an overall risk management perspective to have a portion of my super invested in crypto. So yeah, there's some people that are doing that as well. And there's also, I guess, a number of people that are also just looking to take control, like we were saying before, into by self-custodying or investing into crypto, and they are finding that it's difficult. Not a whole lot of APRA regulated funds are overly friendly to crypto at the moment. A lot of them, either their license doesn't allow it for insurance purposes, or maybe the people that the board of trustees just haven't made that decision to allow their members to have any kind of exposure to this asset class. So when they see that, a lot of people are coming to us and saying, okay, well, the next logical conclusion, it appears, is to self-manage.
And that's such a valid point, because we've seen that so much as well, where people are just looking for some exposure. I mean, we could go down a rabbit hole here, which I'll try to avoid, but there was a lot of data put out really showing that even a small allocation, it only needed to be a couple of percent, made a huge diversification difference, like where you were significantly outperforming not having any at all. So when you've got that sort of data coming out and people going, well, okay, I know I should, probably the sensible thing is to have at least some exposure, not necessarily arguing all in, that I know some people will do. But when they want to do that and they can't do it, that's a real challenge, because people go, well, I can't do it. My fund doesn't allow me to do it. There's no tick box that I can say I want to have a little bit of exposure. So they kind of have to go down this path and do it themselves.
Yeah, they do find that they are forced into this position. I'm sure once APRA regulated funds do start offering this as a product, that there will be some people that actually wind up their SMSFs just because they don't want that extra hassle. And I guess that's a big thing, and we'll probably cover this shortly, but it is a significant time and money investment, self-managing your superannuation. So you do definitely have to have the right mindset to do it. And I guess a minimum balance is sometimes something that a lot of people do need to keep in mind as well. The main reason behind that is purely behind costs. You don't want to bleed out your investment just because you've got all of these ongoing costs to manage.
And I do want to dig into that because this is a question I've had quite a lot, and we've had discussions about that. I've got in the office here, there's some younger guys who are very interested in that and have looked at starting their self-managed super fund. And the big number always seems to be you need to have $250,000. They don't have $250,000 in their super. It's like, it feels like it's an unwritten rule that's what you have to have. That doesn't appear to be the actual rule. Can you talk us through a little bit about what it means when you say the right balance? Because I would imagine it means different things for different people.
That's absolutely right. $250,000, it was previously $200,000. So you sometimes hear those numbers interchangeably. The biggest reason that number has sort of come out as the consensus yardstick is largely to do with costs. On average, we find, and what we estimate to clients is that it costs roughly $2,500 at an absolute base level to maintain an SMSF. You've got three main buckets of costs that you tend to have from year to year. There's accounting fees. There's the cost of having an independent SMSF auditor conduct an audit each year of those same financial statements and tax returns. And then you also have the ongoing costs associated with managing the trustee company. That third one sometimes is opt-in. We generally, without going down a rabbit hole, recommend to clients to set up a company to act as trustee of an SMSF. And that cost is usually a little bit more upfront, but the ongoing costs are negligible in the grand scheme of things. And it's an upfront cost and an ongoing insurance policy of sorts that will save you quite a bit in the long run. But yeah, you're right. That $250,000 kind of represents, at a cost of $2,500 a year, roughly 1% of a fund's balance. So when you look at that, a lot of people will conduct a cost benefit analysis and they'll determine, okay, if it's going to cost more than it otherwise would be to just house my superannuation in an APRA regulated fund where it is right now, then it's probably not worth it. But as you know, crypto being a very volatile asset class, yes, you could lose quite a bit, but there is also potential for outsized returns. Some may double their money within a 6 to 12 month time frame if they time the market right, and over a longer period of time, even more so potentially. So when you look at that, the benefit of going, say, a 2x or a 3x of your initial balance, comparing that to the slightly higher costs of managing that SMSF, you tend to find people will weigh up that cost and the benefit, and they will sometimes come to the conclusion that it's worth them pursuing this. Some people may not. But yeah, it all comes down to everyone's personal risk profile and what their investment time horizon is as well, amongst many other things.
And I think that's a really good explanation, because I know for some people, like we were saying before, if it's the only option they really have, that will be driving them. But for others, when you talk about the control aspect, it can seem a little bit daunting initially, but once you've done it and gone, and particularly once you've got expert help from people like yourselves to go through that process, and you do become comfortable with it, I experienced this where I sort of went, oh, it's scary, and I'm quite comfortable in those areas usually. But once you've done it, you go, well, I just wouldn't go back to not having that control and not having that insight, because most people with their super, you get your statement at the end of the year. That's the only time you even look at it. You wouldn't have a clue what's going on. But when you do take that little bit of extra responsibility with it, it focuses your mind, right? It keeps you sort of paying attention to what's actually important there. And I would argue it is something we should all be paying more attention to it. I mean, for a lot of us, it's only at the end of the process that people start paying attention when they need that money. But if you want more money to live off, you need to have been paying attention as it goes. So are there other factors around that aspect of it that you sort of recommend to people that they need to be paying attention to, or other factors that determine what makes it suitable for them?
Yeah, you definitely touched on one of those categories, the technical competency of taking custody of your assets. And in saying that, it is also worth flagging that it's not necessarily a black and white requirement. If you do want to lean on someone else to custody those assets for you, there are options out there. There are also solutions out there where you can have a social network that helps you to recover those assets if anything was to happen. There's a lot of technological capabilities out there now, things like multi-signature wallets or smart contract wallets, which are becoming more and more accessible and a lot easier to use. So there are solutions out there for everyone. So it's definitely a consideration, but it's not it's not the core requirement for people to know how to take self-custody of assets. So that's, I guess, if that helps to alleviate some of the concerns for some listeners, then that's good. I guess being what we would call a Web3 native, such as myself, or an on-chain native, like you said, you try it once, and once you've learned how to do it, you very rarely, if ever, want to go back, because it is so freeing. But in saying that, again, it's not for everyone, and some people just want to gain exposure to this asset class just for the diversification.
And we certainly, like, thinking from the Ainslie perspective, I mean, we have custody solutions as well, so we can make it really simple, where it's effectively just a statement at the end of the year that you can print out and for your auditing purposes and all of that. So I suppose on that spectrum, it also comes down to what professional assistance you can get. So, if you've got a custodian that you can trust, like in the case of Ainslie, if you can say, well, we're happy to have them custody it, and we're happy to have the assistance of Tax on Chain to help us with the mechanics of doing it, you can do it with a fairly limited experience set.
Yeah, and even cost budget as well. There's a broad range of custodial solutions out there, each with different levels of costs involved. So yeah, there's definitely something out there for everyone.
Now, a big area for us that, and for our customers, it's just really important, is scams. We've just had relentless scam activity. I know there's been lots of data put out that the banks don't want to deal with crypto because of the scams. The people just have really suffered under that. And I could think of nothing worse than having the scam compounded by being in your super, because at the end of the day, there's a lot more regulation around the super space. Like, it's terrible for anyone to lose out to scammers anywhere, but if it's in your super, you've got that added stress that, well, I'm responsible for this, beyond just myself personally. How do you think about that aspect of it, and what's your advice to people, really?
Yeah, that's very true, and all of that is very current. A lot of people will see, a lot of banks, most notably CBA, have got a very strict $10,000 per calendar month limit of what people can transfer into digital currency exchanges, or DCEs. So that does limit things. And I guess what CBA and a number of other banks are trying to do now is limit the impact to potential scam victims. So while it is frustrating for a lot of us that just want to get their money onboarded into the crypto space, it is there for a good reason. I do have to try and reason that with a lot of people.
Mm.
are trying to get their money onboarded into crypto. Sometimes it can take a little longer, or they just have to find a bank that is a bit more friendly to onboarding into the crypto space. So there is help insofar as the banks are trying to limit the amount of exposure that people have to this scam activity. A lot of people are finding that they're getting tricked into investing into a certain investment that sounds too good to be true commonly. It is hard because we then also will turn around and say that you could double your money in a legitimate crypto asset like Bitcoin within a very short period of time. So I guess it does make it very hard for people to reason about those two things. So I guess the biggest thing is remembering that if someone's cold calling you, more often than not, it's not a good idea to pursue that. That's kind of why we would prefer to reach out to people through a medium like this. We've sort of put the information out there, and if people are interested, then they can reach out to us. So that's why having people cold calling is never a good sign. It's a very early red flag. So I would definitely avoid those altogether. Even when you go on chain, for example, internet hygiene is paramount. Yes. Not clicking malicious links and being doubly sure that you're sending money to the right addresses. Things like that will save you a lot. And at the very least, again, limiting your exposure. We recommend to a lot of people not just having all of your assets in one wallet. We sort of recommend people do bit of a reference to Harry Potter here, but Horcrux your assets amongst, split your soul into many different shards, so that if one of these things is lost to either error, clerical error, or malicious activity, you at least have something still left. So there's things like that where you can help to limit that exposure and the impact. And then I guess generally speaking, a lot of older people, or a lot of people that may be of retirement age, may still have these people that are calling and convincing them, or if they're on the certain chat groups online. I guess the biggest thing I would suggest to people is, when you see an investment opportunity, definitely do your due diligence. Don't feel like you have to rush into something. If it's overseas, especially, as soon as you go overseas, it becomes increasingly difficult to be able to claw that money back. At least if it's within the jurisdiction of AFCA or ACCC or ASIC, there is some kind of recourse that is available, or at the very least, they can start investigating that, work with the AFP or local police to be able to track down the perpetrators of that malicious activity, and hopefully in that situation give you a slightly better chance of getting the money back.
It's really a horrible situation. I've seen so many people go through, and you just don't want to be there in the first place, but it inevitably happens to people because they're very, very sophisticated and they're very good at what they do. So it's a very tricky space. I think, I mean, we're running out of time, and there's so many more things I'd like to ask you to go down. We'll have to get you back and talk more of the tax angle and things that I know people will be wanting questions about as well. But for today, that's been fascinating to go down that sort of journey with you on crypto specifically in super. And I think that is an area that we've had a lot of questions about. So I think people really appreciate that. But sort of wrap it up, do you have any closing thoughts or ideas that you'd like to leave our listeners with, and probably also some information on how they can get in touch to utilize some of your services to help them on that journey as well?
Yeah, absolutely. If anyone wants to reach out to us, we've recently refreshed our website. It's taxonchain.io. You can book a consult with us if you would like to have that initial discussion. We're one of few people that do pick up the phone and talk to people, which I know is quite a big point of difference in this day and age. Myself, the directors, Raphael and Oliver, we've got a team here that can take that call. I have quite a general spread of expertise in many different areas. But where I've focused most of my energy at the moment is in the SMSF space. If anyone wants to reach out about some more information for SMSFs, feel free to reach out to me. I guess the only other thing I would leave listeners with is definitely plan your investment. As the old saying goes, if you fail to plan, you plan to fail. Knowing not just what you want to invest in, but how you're going to do it. So like we were saying before, make sure you're picking a reputable exchange, someone that's based in Australia. Make sure you know how you're going to take custody of those assets or what kind of custodial solution you are considering. Remember not to rush into things as well. It comes back to planning your investment properly. So being patient and avoiding fear of missing out, or FOMO, is definitely a big thing too. And a lot of people, I guess, also will say time in the market is better than timing the market. So also it helps to minimize costs when and if you go into this, but less is better. Less is more. Don't overtrade. Don't try to outsmart the market. Just we always suggest you just buy spot and just sit comfy and wait for it to go up.
And that makes so much sense. And I really, just to reiterate for people, that's why we're having this conversation. That I really love your point. Someone on the other end that picks up the phone. That's our whole point of difference here at Ainslie. Real people on the end that can help you through this stuff. And this is another group, tax on chain, that can help us here as well with you to go through that process. So having real people that you can trust on the other end, that you can have the conversation with, makes all the difference. So yeah, really appreciate having you on here today. And I know our clients will as well when they start to look at this and go, oh, okay, that's the area I was really struggling with. So thank you for your effort on that, and thanks for your time on that today, Matt.
No worries. Thanks for having me, Chris.
Thanks everyone for watching. We'll chat again soon.